$89. That is how much a barrel of Brent crude costs today. And it is why the entire stock market is shifting underneath you. Here is how we got here. At the start of July, Brent crude sat at $72 a barrel. That was already up from the low 60s before the Iran war began in April. But last week, the escalation went nuclear. The US expanded strikes on Iranian targets. Iran retaliated, and the world's most important oil choke point started shutting down. The Strait of Hormuz carries 20% of the global oil supply. Last week, S&P Global counted only 127 tanker crossings. That is down nearly 50% from the prior week. Oil surged from $72 to $89 in 3 weeks. On Monday alone, it swung between $86 and $91 before settling at $89.22. A $17 spike in 3 weeks does not happen without consequences. Here is the chain reaction. When oil rises, markets expect inflation to rise. Energy costs flow into everything: gasoline, shipping, manufacturing, food. That expected inflation pushes bond yields higher because investors demand more compensation for holding long-term debt. The 10-year Treasury yield climbed from 3.97% before the war to 4.59% on Monday. That is a 62 basis point spike. The last time yields moved this fast was the 2023 regional banking crisis. Higher yields make borrowing more expensive for companies. They slow economic growth and reduce the present value of future earnings. That math hits growth stocks hardest. The Nasdaq is down nearly 6% from its June record. Meanwhile, energy stocks are leading the market. The rotation is fully underway. Monday showed exactly how this plays out. The Dow dropped 307 points, or 0.6%. The S&P 500 slipped 0.2%. The Nasdaq was flat, but beneath the surface, the moves tell a clear story. Energy stocks led. Chevron gained 1.24%. Companies that depend on cheap energy got hit. Healthcare fell. Materials fell. Industrials fell. JP Morgan dropped 0.6%. Bank of America fell 1.4%. But here's where it gets interesting. The big tech names held up. Microsoft gained 2.21% after announcing it would use AMD's Helios chips on Azure. Alphabet rose 1.36% ahead of earnings on Wednesday. AMC surged 26.8% after recording the highest quarterly revenue in its 106-year history. Domino's rose 2.1% on better-than-expected earnings. The market is not crashing. It is rotating. The most direct impact of higher yields hits housing. The average 30-year fixed mortgage rate just hit its highest level in nearly a year. This compounds an already difficult affordability crisis. Here are the numbers. The 10-year Treasury at 4.59%. 30-year mortgage rates at their yearly high. The S&P 500 still up 18% year-to-date, but 2% below its all-time high from June. The volatility index sits at 18.65. That is elevated, but it is not panic territory. The story is not that markets are crashing. The story is that the easy conditions of the first half are tightening in real time. Here is the part most coverage gets wrong. Higher oil and higher yields have shifted expectations for the Federal Reserve. Markets now see a 55% chance of a rate hike in September. That is up from 51% just a day before and from near zero earlier this year. The Fed held rates at 3.5 to 3.75% in June. Chair Kevin Warsh said inflation remains the primary focus. Higher energy prices make it harder to reach the 2% target. But the labor market is cooling. June payrolls came in at only 57,000. The unemployment rate dropped to 4.2%. A cooling labor market plus rising oil creates a real dilemma. The Fed cannot cut with oil near $90. But hiking into a slowing economy risks a recession. That is why the market is split at 55%. It is not a sure thing either way. This is not the first oil spike. In March 2022, Russia invaded Ukraine and Brent crude surged from $97 to $139 in 2 months. Stocks entered a bear market. Energy stocks gained 35%. In October 2023, the Israel conflict pushed oil from $84 to $96. The S&P 500 corrected 7% over 3 months, then fully recovered. Today, we are at $89, up 17 in 3 weeks. The S&P 500 sits just 2% below its all-time high. The difference this time is earnings. S&P 500 profits are growing 26%. Neither the 2022 nor 2023 shocks had earnings growth that strong. That is the cushion that changes the outcome. This is the data that separates a rotation from a crash. S&P 500 second quarter earnings season is underway. Of the 49 companies that have reported, 90% have beaten estimates. Aggregate earnings growth is tracking at 26%. But the sector breakdown tells the real story. Technology earnings grew at 65%. That is why tech held up on Monday despite the oil spike. Financials grew at 19%. Healthcare at 15%. Energy at 8%. Consumer discretionary lagged at -2%. The tech sector rallied 45% from March through June before pulling back 9%. That is profit-taking, not panic. The fundamentals are intact. The question is whether lofty multiples can survive higher for longer interest rates. So what do you watch next? 3 numbers tell the story. Number 1, the 10-year Treasury yield. If it breaks above 5%, the sell-off accelerates and mortgage rates will break new highs. Below 4.35% and the panic is over. Number 2, Strait of Hormuz tanker traffic. If crossings return to normal, oil drops back towards 75 and the whole chain reverses. If they stay at 50% capacity, oil at 90 is the new normal and inflation stays sticky. Number 3, technology earnings guidance. Alphabet reports on Wednesday. Tesla reports on Wednesday. Intel reports on Thursday. Their guidance on capital spending and demand will tell us whether the AI infrastructure build-out stays on track. The CapEx number matters more than the revenue number. Here is the bottom line for any investor watching this. The oil spike is real. The yield spike is real. But the economic fundamentals are stronger than in 2022. S&P 500 earnings growing 26%. Technology earnings growing 65%. The labor market cooling but not collapsing. The rotation from growth to value is in its 3rd week. History says rotations like this last 4 to 6 months. If you hold a diversified portfolio, this move is noise, not danger. If you are overweight technology, expect more volatility through earnings season. But the long-term trend has not broken. $500 billion in AI infrastructure capex does not disappear because oil went up $17. Earnings are the signal. Oil is the noise. Every chart and every data point in this analysis comes from live market data on July 21, 2026. Subscribe for daily market analysis. The numbers tell the story before the headlines do. This video is for educational and entertainment purposes only. It is not financial advice. Past performance does not guarantee future results. Always do your own research and consult a qualified financial advisor.